Silver prices have fallen dramatically, dropping 22% in just 2 hours. Traders around the world are stunned. This sudden plunge has sent shockwaves through the market. Investors are asking what just happened to silver. Such a sharp decline in a short time is extremely rare. Normally, silver moves gradually, influenced by market trends and economic news. But today, the market reacted with extreme volatility. Panic has set in across trading floors. This drop is not just a number on the charts. It directly affects investors, traders, and industries. People watching the market are scrambling to understand the cause. Questions about long-term effects are growing fast. In this video, we will break down everything. We will explain the reasons behind the sudden fall, the impact on investors, and what experts are saying. By the end, you'll understand why silver shocked the world. Silver is one of the most traded precious metals in the world. It has both industrial and investment uses. From electronics to jewelry, silver is a key commodity. Its price movements can affect global markets. Investors often use silver as a hedge against inflation or economic uncertainty. Traders watch silver prices closely because sudden changes can signal larger market trends. It is known for steady but slow price movements. Unlike gold, silver is more volatile because its market is smaller. Small changes in demand can lead to big price swings. Today, the 22% drop proves how sensitive silver trading can be. Understanding silver's role in global markets helps explain why such a plunge is shocking. It affects not just traders, but also industries, investors, and even currencies linked to precious metals. Silver fell from around $28 per ounce to $21.80 per ounce in just 2 hours. That is a 22% loss in record time. Normally, silver moves only 1–2% per day. Today's drop is historic. In comparison, gold fell by only 1.5% in the same period. This shows that silver is much more reactive to sudden market changes. Investors who held positions were caught off guard. The trading volume also surged. Millions of ounces of silver changed hands in just a few hours. This shows panic selling dominated the market. High-volume trading often worsens price declines. Analysts are comparing this drop to previous silver crashes. It is rare to see such a sharp decline in under a day. This event will be studied by traders and economists for years. Several factors likely caused the sudden drop. First, large traders or whales may have sold huge amounts of silver. This sudden supply pushed prices down rapidly. Economic news also contributed. Reports of slowing industrial demand or stronger currency can trigger panic. Traders reacted quickly, amplifying the fall. Speculation plays a major role. When investors expect prices to fall, they sell aggressively. This creates a chain reaction that accelerates the drop. Finally, market algorithms may have amplified the movement. Automated trading systems can trigger massive sell orders in seconds, making sudden declines even worse. The silver crash did not happen in isolation. Other precious metals, such as platinum and palladium, also faced pressure. Traders watched these metals closely. For market trends, stock markets reacted as well. Companies tied to silver production or usage saw their stock prices drop. Global investors grew nervous, fearing broader economic implications. Financial news platforms reported high volatility in commodities markets. Investors in Asia, Europe, and the US quickly adjusted their positions to manage risk. The reaction shows how interconnected global markets are. A single sudden move in silver can ripple through commodities, stocks, and currencies worldwide. Silver has experienced crashes before, but rarely this sharp. For example, in 1980, silver prices surged and then collapsed rapidly. Today's 22% fall echoes those past shocks. The difference is speed. Previous crashes took days or weeks. Today, the drop happened in just 2 hours, making it far more dramatic. Traders often use historical context to predict recovery. Past data shows that silver can bounce back after sharp declines, but timing is uncertain. This event will become a benchmark for future market studies. Investors will compare future drops against today's historic plunge. Small investors face immediate losses. Many held silver expecting steady growth. A sudden 22% loss can wipe out months of gains. Margin calls may force investors to sell. This increases selling pressure, pushing prices even lower. Panic selling creates a vicious cycle. Long-term holders may be tempted to sell in fear. This can hurt portfolios, even if silver recovers later. Emotional trading often leads to bigger losses. Expert advice is clear. Stay calm. Understanding market movements and avoiding panic decisions is crucial during sudden crashes. Silver is used in electronics, solar panels, and jewelry. Companies relying on silver may face higher costs if prices rise later. Supply chains could be disrupted. Sudden price changes create uncertainty for manufacturers and traders. Some may delay production or purchases. Jewelry makers and tech companies closely monitor silver prices. A 22% drop affects their buying strategies and profit margins. The industrial impact may take weeks or months to unfold. Today's price shock is a warning for both traders and businesses. Market analysts call this drop a major warning sign. Volatility in silver can signal instability in broader markets. Some experts see a buying opportunity. Cheap silver may attract long-term investors looking for value. Timing, however, is key. Others advise caution. The market may continue to drop if panic spreads. Short-term trading can be risky during such volatility. Overall, experts agree. Watch the market closely. Decisions should be based on data, not emotion. In times of sharp drops, charts show silver broke key support levels. This triggers more selling and confirms bearish trends. Momentum indicators suggest extreme volatility. Prices can swing sharply in either direction. Traders must be ready for rapid changes. Previous patterns show silver may rebound after steep declines, but timing is unpredictable. Recovery could take days or weeks. Technical analysis helps traders manage risk. Watching support, resistance, and volume levels is critical in volatile markets. Silver could recover quickly if panic selling ends. A bounce back of 5–10% is possible within days. Alternatively, the drop may continue. If investor fear spreads, prices could fall further. Monitoring market sentiment is key. Global events and economic news will shape the next moves. Investors should stay updated on policy changes, industrial demand, and currency trends. Patience and careful strategy are essential. Sudden moves are rare but impactful, and informed decisions will help weather the volatility. Silver's 22% drop in 2 hours is historic. It highlights how fast markets can change. Investors must stay calm, analyze the data, and avoid emotional decisions. Panic can lead to bigger losses. Industries, traders, and global markets all feel the impact. Understanding these effects helps plan for the future. This event is a wake-up call for everyone in the market. Watching trends, technical indicators, and expert advice is more important than ever.